For years, the advice about debt was simple: pick a plan, pay one loan off faster, repeat. This worked well when interest rates were low and predictable, but that world has changed. High interest rates are not just a number on a screen. They are a force that reshapes your monthly budget. They change the math of what it costs to borrow money. That change requires a new way of thinking about debt. Less speed, more survival. The pressure is the most important part. When interest rates rise, your monthly bills can climb. Credit card balances that were manageable last year can become heavy burdens this year. A variable rate loan might adjust upwards, eating into money you needed for groceries, gas. This constant rising pressure on your cash flow is the real danger. It can force you into making bad decisions. Most common debt payoff plans are straightforward. There is the debt snowball. You pay off the smallest debt first for a quick psychological win. There is the debt avalanche. You target the highest interest debt to save the most money over time. These methods are clear and logical. They gave millions of people a path to follow, but they were designed for a different economic climate. They assume you have a stable, predictable amount of extra cash each month to throw at your debts. That assumption breaks down when interest rates stay high. A small increase in a variable rate can wipe out the extra money you plan to use. Your minimum payments can swell, leaving you with less discretionary income. Suddenly, the plan that felt empowering now feels impossible. You might be following the rules perfectly, but the ground has shifted beneath your feet. The old plans often ignore immediate pressure on your monthly cash. A large, low-interest mortgage might be your biggest debt, but not necessarily your biggest problem today. A smaller, high-interest credit card balance whose rate just jumped is a much more immediate threat to your monthly stability. The old rules do not always distinguish between a long-term cost and a short-term crisis. They treat all debt as a homogeneous problem to be reduced, rather than a collection of different risks to be managed. This mismatch can lead to a dangerous situation. If you are rigidly focused on paying off one specific loan according to a preset plan, you might ignore a more urgent threat growing elsewhere. You might be sending extra money to a stable student loan while a variable rate line of credit spirals upward. This is like polishing the brass on a ship while a small hole in the hull gets bigger. The old rules can create a false sense of progress while your overall financial position becomes more fragile. Ask yourself this: are you trying to get out of debt the hard way, or are you reducing the pressure in a way your cash flow can actually survive? To navigate a high-rate world, we have to stop thinking about debt as one single number. It is not just a total amount you owe. It is a collection of different obligations, each with its own character, each with its own risk profile. Some debts are like a slow-moving glacier. They are large and long-term, and they do not change much month to month. Other debts are like a flash flood. They can rise quickly without warning, threatening to overwhelm your financial defenses. The most useful way to rank your debts now is not by size or interest rate alone. It is by cash flow risk. Ask this for each debt: how likely is this to cause a problem for my monthly budget soon? A fixed low interest rate with a predictable payment has very low cash flow risk. A variable interest rate with a high balance has extremely high cash flow risk. That is the debt that can disrupt your life. Consider two scenarios: $200,000 mortgage at a fixed 3% rate, $10,000 credit card balance at a variable 28% rate. The old debt avalanche method says focus on the credit card, which is right, but that does not capture the urgency. The mortgage payment is stable. You can plan for it. The credit card payment is a moving target. Once you start seeing debt through the lens of risk, you can begin to spot the specific features that create the most pressure. These are the pressure points in your financial life. They are the vulnerabilities that can turn a small problem into a big one when interest rates are high. Identifying them is the first step toward building a better defense. They usually fall into a few clear categories. Look for them in your list of debts. The most obvious pressure point is any debt with a variable interest rate. This includes most credit cards, home equity lines of credit, personal or business loans. When the central bank raises rates, interest on these loans often rises automatically. Your minimum payment can increase without borrowing another dollar. That unpredictability is a direct threat to your budget. It makes planning impossible and can eat any extra cash you had. Another major pressure point is high interest revolving debt, typically credit cards. The balances on these accounts compound quickly. If you only pay minimums, most of your payment goes to interest, not principal. The balance barely moves or can grow if you keep using the card. It becomes a treadmill. You run hard just to stay in place. That drains your cash flow month after month. Finally, watch for debts with inflexible terms or harsh penalties. Missing a payment could trigger a large late fee, a penalty interest rate, or even default proceedings. Those features remove flexibility when you need it most, like a car repair or medical bill. A debt with no wiggle room is high risk. These are the debts that can force you into a corner. A smarter approach to debt in this environment is a deliberate defensive sequence. It starts with protecting your immediate cash flow before moving on to aggressively paying down balances. The first step is to separate the concepts of liquidity and solvency. Liquidity is the cash you can access now. Solvency is your long-term net worth. In a high-rate environment, liquidity is king. You must protect it first, even if it means slowing down your attack for a short time. Next, map your entire debt stack. Create a simple list or spreadsheet. My debts, credit card. My debts, car loan. My debts, student loan. For each debt, write down the total balance. Write down the interest rate. Note whether the rate is fixed or variable. Write the minimum monthly payment and note the lender. This map gives you a clear picture of your obligations. It allows you to see where the pressure is coming from. Circle the debts with variable rates. Highlight the ones with the highest interest rates. Note which ones have the most rigid payment terms. This map is your guide to action. Identify the biggest pressure points and explore your options. This is not the time to be passive. Call your lenders. If you have a high-rate credit card, ask if they have any retention offers, like a temporary lower rate. If you have a variable rate loan, ask if it can be converted to a fixed rate loan. Consider consolidating several high-interest debts into one personal loan with a lower fixed interest rate. The pressure of high interest rates is magnified for those with uneven incomes. Entrepreneurs, small business owners, freelancers cannot rely on a predictable paycheck every 2 weeks. Their income can swing wildly from one month to the next. A great quarter can be followed by a terrible one. For them, a rigid debt payoff schedule is not just difficult, it can be dangerous. It does not account for the natural cycles of business, and it can create a cash flow crisis during a slow period. For an entrepreneur, the number one priority must be the survival of the business. This means protecting the business's liquidity above all else. Before you use company profits to aggressively pay down a personal or business loan, ensure you have a substantial cash buffer. Many businesses fail not because they are unprofitable, but because they run out of cash. A good rule of thumb is to have enough cash on hand to cover 3 to 6 months of fixed business expenses. This buffer is not dead money. It is survival insurance. Business owners should be especially wary of variable rate debt. a variable rate business line of credit can become incredibly expensive when rates rise, squeezing your profit margins when you can least afford it. Wherever possible, try to lock in fixed rate financing for core business operations. Also, be extremely cautious about personally guaranteeing business debt. This links your personal financial health directly to your business's fate, removing the protective barrier between the two and putting your family's assets at risk. The strategy for an entrepreneur is to plan for volatility. Treat uneven months as a normal part of doing business, not as an emergency. Once your cash buffer is strong, you can then allocate a portion of your profits to debt reduction. This approach prioritizes resilience, ensuring the business stays healthy enough to generate the future income needed to pay off the debt for good. Once your cash flow is stable and the biggest risks are managed, you can return to an offensive posture. Take any extra cash you have and direct it toward the debt that still poses the greatest threat to your monthly budget. This two-phase approach, defend first, then attack, is more resilient. It ensures you can survive the immediate storm, so you have the strength to win the long-term war. Protecting cash flow keeps your financial ship afloat. Once stable, you can move faster toward your destination. Protect your ability to pay bills each month without fail. Preserve your liquidity. Liquidity means cash on hand. Liquidity be cash you can get quickly. It is your breathing room, your buffer against surprises. This is a shift from offense to defense. Think of it like a ship in a storm. First priority, keep the ship from taking on water. Protecting cash flow keeps your financial ship afloat. Then, intensify payoff on the debts that remain the most dangerous. Pressure first triage. Separate liquidity from solvency. Map the debt stack. Identify the biggest pressure points. Explore restructuring or consolidation. Preserve breathing room. Then intensify payoff. In a world of high and unpredictable interest rates, the ultimate goal of debt management changes. It is not about reaching a zero balance as fast as humanly possible. The highest goal is to maintain control. Control means you have choices. When you have liquidity and your monthly cash flow is stable, you have the power to make decisions from a position of strength, not desperation. You can say no to a bad deal. You can weather an unexpected expense without taking on more high-cost debt. You can keep your options open. High interest rates are designed to erode that control. They work by making your monthly obligations heavier, reducing your financial slack until you have none left. Preserving your liquidity is how you fight back. It is the act of intentionally keeping your options open. Think of it as a strategic retreat to a more defensible position. It is not a sign of weakness. It is a sign of smart, adaptive planning. You are choosing to prioritize stability today so that you can have a better tomorrow. This strategy is not an excuse to be slow or complacent. It is about intelligent sequencing. The sequence is critical. First, you stop the bleeding. You take defensive actions to make your monthly budget survivable. You renegotiate, you consolidate, you do whatever it takes to lower the immediate pressure. Second, you build a small wall of stability. You create a cash buffer that protects you from life's shocks. Third, and only then, do you go on the attack, accelerating payments on the debts that remain. Ultimately, high interest rates did not break the concept of debt. They simply changed which debts are the most dangerous. The right move is not always to run faster. It is to triage the problem, protect your cash, reduce the monthly pressure, secure your breathing room. This is how you stay in the game long enough to win. If you want to maintain control over your financial life, you must make survival your primary strategy. Everything else comes after that.